Hey guys, Tyler here. Today we're going to be breaking down the new changes for conventional loans as a result of COVID, as well as the requirements to qualify for a conventional loan. Now, you nor I have all day to sit around going line by line where I elaborate on each line item and do a cost comparison of the different loans that are out there. Today is going to be quick and to the point. No fluff. So grab a pen and paper to take some notes, and if you're ready, let's go. Let's start off and set the stage on what conventional loans are used for. You can get a conventional loan for a primary home, a secondary home, or an investment property. This is the only Fannie and Freddie Mac backed loan that allows you to purchase a second home or investment property, which also includes multifamily units up to 4 units. Now, since COVID, it might seem more difficult to qualify for a loan, and honestly, that is the case. Conventional loan requirements have not changed, but the banks, because of COVID, have overlaying restrictions on their loans, like requiring higher credit scores in this case. Conventional has a minimum credit score requirement of 620 points. But remember, the banks can overlay additional restrictions, so you'll need to check with each bank on what their minimum requirements are for conventional loans. A 680 credit score tends to be the best. Otherwise, you might get penalized by having a higher interest rate. And a 2-year credit history is also preferred when getting a conventional loan. Now, if you've had a foreclosure, short sale, or bankruptcy, here are the associated timeframes you'll have to wait to qualify for a conventional loan. For those of you that have student loans, Fannie and Freddie Mac, who is buying these conventional loans from the banks, require you to reduce what you qualify for by your student loan minimum payment. Or if your payments are deferred, then 1% for student loan amounts for Fannie Mae and 0.5% for Freddie Mac. At the end, I'll run through an example that you can follow along with and put in your own numbers to get a really good idea of what we're all talking about here. Let's talk about down payments. If you are a first-time home buyer, you can put down as little as 3%. If you're not a first-time home buyer, but you have someone on the loan who is, you can also qualify for a 3% down payment. Now, if neither of you are first-time home buyers, there are programs out there called the Home Ready and the Home Possible programs that allow you to put down just 3%, but there are some income limitations with these programs that you'll need to be aware of. I'll put information in the description about these programs below. And while you're down there, make sure you hit that subscribe button and notification bell. And guys, I really appreciate it. I love doing these videos and I appreciate your support. Now, while we're talking about down payments, it's important to note that your interest rate, while it is dependent on your credit, it is also affected by how much you put down for your down payment. You will typically see higher interest rates with lower down payments, and vice versa, lower interest rates with higher down payments. The standard for conventional loans is putting 5% down for your down payment, but you can also put down more, which will also reduce your monthly payment about $6 for every $1,000 you put down. So if you put an extra $2,000 down for your down payment, you will see a reduction of about $12 per month in your monthly payment. The big change though is when you hit that 20% down, which will remove your private mortgage insurance, which in some cases can range from $100 to $200 per month, and that is added on top of your mortgage payment. PMI is required on all Fannie and Freddie Mac loans, but only conventional loans allow it to be removed when you have 20% equity. At 20%, you must request your bank to remove it, or it will automatically drop off at 22% loan to value. To get the funds for your down payment, you can do regular income, gift funds, and 401k loans to supply your down payment, but you will want to make sure that you're able to track where your funds are coming from. So if you have cash that's been tucked underneath your mattress for the last 20 years, sorry, you won't be able to use it. Now, your closing costs are going to be the same as any other loan, but there are some limits to how much you can ask a seller to cover through seller credits or seller concessions. If your down payment is less than 10%, which a majority of them are, you can only ask for 3% of the purchase price in concessions. If down payment is between 10 and 25%, it's 6% in concessions that you can ask for. And anything above 25%, you can ask up to 9% in seller credits or concessions. Conventional loans also have a loan limit that you need to be aware of, which is $548,250. And this is up over $30,000 from last year. Now, the loan limit is not the purchase price. To determine what the purchase price would be when considering the loan limits, you will want to take 1.03 times the loan amount to come up with the purchase price if you're putting down 3%. If it's 5%, then it would be 1.05 times the loan amount. To get a conventional loan, the employment requirements are pretty relaxed. They're looking for a 2-year work history for stable employment. There is not a set length of time at a specific job, and you are also allowed to have frequent changes if the changes are within the same line of work. Now, how much you can qualify for is dependent on your debt to income ratio, which for conventional loans is 49.99%, or 50% to make things much easier. So you will want to take your gross monthly income and times that by 0.5 or 50%, and this is the max amount you will be able to have as a mortgage payment. Now, you must subtract all of your monthly revolving debts and student loan payments from this amount, leaving you with the amount that you actually would qualify for. So let's go over an example. You can follow along, but just plug in your own numbers where it's appropriate. In our example, Jeff makes $5,000 in gross monthly income. You will want to multiply 0.5 to this number. Before we can determine how big of a mortgage we can afford, we have to do a few things to this number. We have to subtract any student loans and revolving debts. So in this case, we have $40,000 in student loans, and that monthly payment is about $400, which is 1% of that $40,000. Now, this leaves Jeff with just about $2,100, but he also has a $600 car payment, and that drops his available funds down to $1,500. Now, if you throw in there his credit card payments of $100 a month, he is down to about $1,400, and that is how much Jeff would approximately qualify for when getting a conventional loan. Guys, if you're considering purchasing a home and would like to get connected with a trusted realtor or lender in your area, I'd be happy to help. Please reach out. You can find our information in the description below this video. Guys, thanks for watching. I love you all. I appreciate you, and I look forward to seeing you in the next video.